This is Nav Mathur. I head up solutions at Neo4j, and really excited to be here with our partner ICC in Columbus, Ohio, and bringing this webinar to you jointly. This webinar on agile and adaptive approaches to address financial services regulations and compliance is part of a series of webinars on master and metadata management. And today we're going to focus on BCBS 239 in terms of financial services regulations, but also related to that is, CCAR, Basel III, and Dodd-Frank, and all of them share sort of a lot of common data sets. And so we're going to focus on the data and how we can use some innovative approaches to deal with the data in order to comply with these regulations. So BCBS really stands for Basel Committee on Banking Supervision, and it was really an outcome of the weaknesses that were identified, in the risk data aggregation and reporting capabilities that came out of the financial crisis in 2008. With Lehman going down and all of that happening, there were banks that had a hard time sort of assessing the risk. And I was just talking to some friends of mine at some large banks, and they were doing every 2-hour reporting on the risk numbers to the chief risk officer for 2 weeks straight, and those numbers kept on changing in terms of the level of risk that they had to a Lehman default, as an example. And that is just not acceptable anymore in a financial services company today, and the need to have a really good idea of risk exposure to a default or to commodity prices changing is really the need of the hour. So they are actively, a lot of these organizations are actively working to bring multiple data silos together to assess this enterprise risk. And that's, what we're going to talk about in a nutshell today. So you have a lot of data that is related to risk. You have geographical data, location data. You have, the vertical exposure in a particular industry vertical. You have, geopolitical events happening that are risky, and you have commodity and asset prices changes. You have company financials that you need to sort of look at to assess risk based on the company financials changing. You have sort of the investment in that company, the investor profiles. How is that investor doing? Are they likely to pull out or want a change in control, of the company? You have, your lender profile. So the debt that you have, who is the lender? What is their risk profile looking like? And then you have sort of the actual deal maker or trader that is making the deal, and what kind of risk appetite do they generally have in their deals and trades. So there's a lot of data that is at play here in terms of assessing a risk of any deal. And also, if, you have a lot of opaque sort of counterparty deals that involve third-party assets or collateral as part of the deal, and to assess that as well, it's kind of like peeling the onion, and you need to assess not only the two parties that are involved in the deal, but any other assets that are pledged as part of the deal, and then going out from there, who's pledged the asset, what is their risk exposure, and are they likely to, is that value of the asset likely to reduce, based on some event happening. So I think the message is really that, bringing all this disparate data together is what will help you assess the risk, and we can do that with a graph technology like Neo4j, and we'll talk a lot about that in the session today. Just to recap, we talked earlier in the first webinar about what MDM has to do with innovation, and we talked a lot about the emerging applications. So from a financial services perspective, impact analysis, risk management, recommendations, compliance and traceability of that. These are the applications that financial services companies are really focused on today, which really deals with a lot of connected data that is coming from multiple data silos. And the data warehouse and data lakes are really not cutting it from a technology perspective, because they are that they really deal with old data, at least a day old in most cases, and slow batch processed data. And what we're really looking for is highly connected data that can be queried in real time to give you a real live perspective on the risk, on the impact, and on compliance and ad hoc drill down reporting and so forth. So and then for the second webinar, we talked about GDPR, the General Data Protection Regulation in Europe, and how not only European companies but US companies have to adhere to this regulation and illustrate that they're trustworthy to be able to handle this data. And you have to have a really good idea of where you source the data from, how you're using the data, and how the data is changing, and who has access to the data, and all of these things actually is maintained as a map from your source, and the fact that you have a permission to use this data from the individual. This is individual personal data or personally identifiable data, as it's called here in the U.S. regulations. And that's really a data lineage. So it's really mapping the source of the data to where the data is being used and everything in between, what is touching the data. And you need to have a platform that is able to do the data governance on this type of connected data and maintain this type of data lineage as a map. And again, Neo4j is the right technology to map this as a graph and have this data lineage available at all times to satisfy reporting and regulatory needs. And then, so for today's talk, we have Jonathan, Kelsey, and Lee presenting together with me, and I'll let them introduce themselves as we go into this webinar in a little more detail. ICC as an organization, I'll let Jonathan introduce that, and then we can go into Jonathan's section here right after that. So Jonathan, over to you.
All right. Thank you very much, Nav. Again, like you stated, my name is Jonathan Renner. I'm a principal banking consultant here. I've got a fairly rotund background in CCAR and regulatory. I've done a lot of banking data-centric analysis to support, risk and regulatory, and also the finance FP&A kind of world. And then certainly part of that is the redundancy elimination that comes with process automation and the engineering associated with that. ICC is a company that deals a lot with sort of data-driven tasks across a whole range of industries. And it's Lee or Kelsey, you might be speaking more to specifically the ICC part, but and we'll get to that in a minute. As it relates to banking, it's a huge vertical, not only for us, but for significant cross-section of a lot of different data-centered companies. And a big question in that is certainly appropriation of better MDM tools and resources, and with that is a proper approach as it relates to data lineage itself.
Jonathan,
so
go ahead.
Nope, go ahead. You're in the. I'll clarify one thing for the audience. I'm the only one who's not in the room. Unfortunately, I'm traveling, so I'm kind of between cities. So I had to find a good place to be. So I apologize if it seems like I'm a little bit out of the loop comparatively to the rest of the cast and crew. Go ahead, Nav.
Yeah, so Jonathan, we're on the business challenges with regulatory compliance and banking slide. So go ahead and you can talk to it and just let me know when
okay.
to put slides.
Absolutely. So as you can see, compliance failure is something it's measured in a lot of different levels, and to some degrees it's up for interpretation between the FRB, Federal Reserve Board, and the OCC. So depending on how they're looking at it, your sort of changing of the guard with the regulators that come in, you kind of got to, if you've ever been behind the table from them, you understand that they will morph with their interpretation of different compliance rules and regs that come along. So kind of like Nav had mentioned, with the crisis that sort of began to really unfold in 2008. I'll just kind of recap a story about Lehman. So that weekend, they've got an infamous weekend that I think people still talk about, where they were trying to trace all of their counterparty exposure, and they really began to find that there was sort of a cascading effect of their inability to be able to unwind that. So as they sort of moved city to city, trying to get information back to their risk directors and the chief risk officer, et cetera, they determining their firm's exposure from the counterparty and the issuer perspective really became a defining factor in their survival, to which ultimately they did not survive, as we all know. This sort of frenzy of activity and cascade from the credit business was felt across the organization, and part of it was how they were structured, the sort of relationships that they had with their party and counterparty. But even with that, the data itself was a problem, that it wasn't centered in a way that they could really give very timely, organized data sets measuring these sort of trading risks as they were happening, across the globe. So the exercise showed everybody the importance of having a single risk aggregation platform. That way they could capture and compute risk across the organization uniformly. I think a big part of this is known now. It's like the processes that were working sort of pre-crisis were just not going to be acceptable anymore. A lot of people think the pendulum has probably swung a little bit too far with the implications of everything from Dodd-Frank, CCAR, Basel, BCBS, but it has certainly required all the significant institutions to really shore up their sort of data platform foundation. One of the biggest things that really gets the banks sort of warmed up is the MRA avoidance. Some of them are worse than others. So the where this comes into play is if the data management strategy doesn't allow you to do particularly capital actions around mergers and acquisitions, that's when the C-level and the board really gets heated up, and certainly the shareholders. I've got a couple estimates in here, which are these are pretty wide. Trying to use trusted sources to estimate it, but the compliance cost, the tooling cost, the people, the specialists, everything involved it is estimated to be around $100 billion as of last year, and maybe a couple $100 billion across the globe. So with BCBS, certainly coming, it's something that is taken very seriously. Now, at the same time, the FIs and the banks don't, they've kind of gotten tired of spending so much on compliance when they're trying to innovate and create other tools and things for, their customers and the revenues that come with that. And really quick, the additional regulatory requirements around Dodd-Frank, CCAR itself, and Basel III, like Navneet mentioned, there are a fair amount of sort of commonalities when it comes to particularly the balance sheet. So the asset side of the banks, the loans and loan characteristics, there's a lot of crossover. Early on, a lot of institutions kind of had separate ways that they were dealing with these things. The BCBS path will sort of get them to finally get to a common tiered foundation, so that there isn't any question. Any given group that does anything from the regulatory, reporting production through the FP&A, finance, and risk certainly will all be on the same page. Even it's kind of interesting. You'll see the different sort of interpretations of current position by different kind of data dimension. When you get it all on the same foundation, everybody's speaking the same language. I'll go ahead and move on to the next slide for the specific use case about BCBS 239. I think everybody knows what it is. Everybody's probably heard of this, some more than others. Some conferences, even a couple of years ago, it was almost comical how much this was thrown around as sort of as a buzzy term. It was crafted in 2013. It was supposed to be adhered to by at least the GSIBs in 2016. The adoption rate, I don't even know if it would really be considered 50% yet by the big globals like Bank of America, Chase, Citi, etc. It is extremely data focused. I'll talk about a couple of the pillars in the next slide, but there are pillars and principles by which this MDM, a good sound platform for data lineage, and why that makes sense to satisfy the 239 ruling exists. The cost of violating these rules, it's again, it's kind of up for interpretation. It's hard to tell exactly what the cost really would be. Unlike some other compliance areas for banks, it's the fines aren't specifically defined, such as like for trading violations or for currency manipulation events. Those are pretty easy to find specific fine amounts on. A lot of the Dodd-Frank CCAR kind of space, it's the effect. I mean, the overall score is known, and this time around for the filing was due for this year. All the banks passed, so I think that's a first, if I recall. But there aren't, other than the inability for banks to be able to do their M&A activity or capital actions, it's hard to put a price tag on it. Some of the thoughts as I wrap this slide up around 239 is that realistically, it should be a good thing for the bank sort of platform. We'll get them on the same page around increasing revenue, because they'll actually be able to understand their sort of customer relationships, which is another great thing that Neo4j does well, is understanding those customer relationships and using graphs. But right now, it's a lot of banks kind of struggle with understanding that in their own data and in their own kind of messy MDM world. Capital management lift through a reduced risk-weighted assets buffer. Right now, there's there's some pretty tight RWA buffers that happen across their strata of their loan assets. Operational costs, you know, again, it comes down to redundancy of processes and of systems where there's partial things happening across 2 or 3 or more places that just it doesn't need to happen that way. And then some direct expense positive implications around some of the IT overhead with streamlining of tools. All right, so slide 12 is all about the specific data lineage and you know the sort of the framework of the overall pillars and then the principles themselves. So,
hey Jonathan, I'm going to interrupt you real quick. I apologize, but I think we're having one of those instances where different rooms, so we're having a complex. So actually, if you have any closing thoughts on banking regulations, absolutely. And then we actually are moving on to data lineage and practice as our next slide.
Okay, yeah, that's great. I mean, I think I've covered what I need to cover. This is an important topic for all the, you know, the $17 trillion that's held in FIs in the U.S. This has got large implications. Thanks.
Yeah, thank you. My name is Kelsey Bieri. I'm a consultant here at ICC in our Master Data Management and Data Governance practice. I have worked on a variety of data governance projects that span across different industries, weighted heavily in banking have been the majority of my projects. And I'm also the consensus product lead at ICC, which is a tool that we own and license that revolves around data governance, prototyping, and all those fun, fancy things. So what I want to dive into here is talking about kind of the data lineage, what it is, and building a story frame before I hand it off with Lee, just to kind of really build out what it is that we're trying to address using a variety of examples that we have seen and really tracking that data life cycle. So when we're going in here, ideally when we're envisioning data lineage, it's hierarchical in our mind. So we're starting off from this, we have business area, this can be substituted as domain, line of business, depending on cultural preferences and how your actual industry is set up. But then if we're going into entity, and when entities contain attributes that link to columns that are part of tables and databases, right? We view this as a very simple start to finish if we're laying it out on paper. But as we know, it can be something that's way more complex. So if we're actually relating it to something we might see, so if we're working with a domain that's an account, which has a report that contains a loan number, which links down to our column of a loan number from the actual physical name, belonging to a table, belonging to a schema of some sort. So we see this from start to finish, but in actuality, it's much more complex than this. So we might have a domain that links up to this loan number, but then there's the situation of where is this column actually coming from? Is this the first place that we're seeing this information? Is it feeding from somewhere else? So we have these concepts of data hops that are happening, which are actually spreading over how many schemas deep. So that's one of the problems that we see, is that something that starts off as being very simple kind of can explode out to this larger map. So kind of putting those into pain points. We went through and we were brainstorming different pain points that we see and that we have seen in data lineage, and we're talking with Nav and Jonathan. We meaning Lee, sorry Lee, I realize you haven't introduced yourself yet. Webinars are a very different cultural shift for me because I don't have audience feedback, so I can't see body language. So I apologize if there's a lot of awkward one-sided jokes on my end to the audience overall. But what we've done is create pain points from a variety of complexities, and then within the pain point themselves, we can see different levels of simplistic and complex depending on what we're working with. So to start off is kind of a feeding off of what we had in that previous slide. So we have lower levels mapped to higher levels, and so that what we see isn't really what we're always getting. And it's not, you know, we have the iceberg situation. Talking is hard for me today, I apologize. And then what we have with that situation is that these become heavily business-based or knowledge-based, meaning that it becomes a crucial necessity that people understand intimately how all of these things connect together, as opposed to someone being able to track it by querying something or by looking through and saying, okay, I can easily go in and digest this information. You have to have extensive knowledge of what's going on possibly outside of your own specific area, and that can lead to issues. Importing legacy ETL left behind, compatibility across platforms. This leads people to having to maybe hack their way around. You have to take shortcuts or maybe kind of push things through that you wouldn't normally be doing, and that causes its own set of issues. If we're trying to hack the system to make it work for us, then what do we lose in that process, and what are we failing to gain with that? Moving forward, when these are talking about like basic transformation problems, so columns can be stored across multiple tables. So if we're trying to do that traceability, we're opening up the door. If we see that loan number is stored in multiple tables and we're tracing it out into the report, or if we're tracing it down to the schema, how are we keeping track of that? And the same thing for if we have columns that can become mini columns and vice versa. So if we're working with a composite key, that's something broken up, or if we're looking at a date timestamp, is always a very easy example to utilize if we're keeping them together in one and then splitting them up in a different table in a different transformation. Or even I've had a situation where date was the source, and then it went into two different target columns, one of which was also stored as a date and one of which was stored as an integer based on the team's needs. So that creates its own variety of problems, because if someone's looking at that and they're trying to trace back the source, how is that happening? And then moving on to, or extending on from transformation logic, it's difficult to store in terms of where we're storing it, difficult to model in traditional RDBMS, and not knowing the direction with an explanation point, because this is such a crucial thing. So are we storing transformations on the source itself? So saying, okay, this is what I'm going to be going through. I'm personifying the column here. This is what I'm going to be going through to get to the target. Or are we attaching it to the target? Say, this is what I went through to get here, and you have to trace that information back. There's also the option of storing a transformation as a third-party entity, essentially breaking that up, putting the source to the target being the transformation itself, that transformation becoming the source and doing it to the target. So splitting that out, but it really is that third-party entity. So where are we storing it? But ideally what we have is, instead of creating it and this more of a complex infrastructure, is that we're storing it on the relationship itself. And that's the ideal part that we're doing, is that that relationship is storing the information. And this is a common practice that we try to get to. Tools that are actually capable of storing the information on the relationship sometimes can be limited in their functionality, or when they're actually displaying the information, it comes in tabular form. So it's really not providing that insight that you were looking for, because you still are approaching it in that way. Additionally, more kind of abstract concepts is that it can be incredibly expensive, time-consuming, and manual-intensive. And this can lead to a variety of problems with team dynamics and communication across different silos, because if it is something that it's too difficult to explain or to walk through, or too difficult to try to explain to new people, then sometimes this can become very intensive for one or a very small amount of people, but this kind of consumes their day-to-day life, and they're not really able to do the job that they were originally signed up to do or hired on to do, because they're so consumed with keeping track of this. And that provides a lot of issues. So creating data lineage is a network graph. So this is a more extensive, Lee was very kind to put this together for me to show the complexity of what we're actually looking with. So if we're many-to-many relationships that need to be accounted for, we don't live in a one-to-one world, and relationships between columns, tables, and databases, tracking that as we're going through, and easily tracing our source to target to store transformations as properties on relationships. And I can't express this enough on how important that is, because I've had several headaches myself trying to track, okay, well, this is the transformation, but is this going for the source, the target, where is it coming from? So that kind of feeds into what I was talking about, needing that extensive background knowledge to even do day-to-day activities that shouldn't be as that intense. But for a real-world example, this is our beautiful client that we're working with. This is a banking client. And this is based off of a project that ICC actually was working with. So we had a client who had different teams of a variety of sizes, and each team was in charge of a source system. So they were in charge of their own source to target mappings based on what they were dealing with specifically. And we have this situation where these teams are based in different areas. It's a very common practice to work from home, depending on what company you're working with, and we actually had that situation here. So we had somebody who lives 45 minutes away from the office, we had different states. We had one in New York and one in Illinois, so that's not necessarily easy if you have to get somebody in the same room, if for some reason Skype isn't working or you're not getting across the communication that you want to. And then we have people who are in different locations working for the same company, but not working from home, still in buildings. But so as I was saying, each of these people were in charge of different source to target mappings, and they were actually keeping track of these mappings in Excel. So this was their attempt at doing data lineage. The issue with this is that they didn't have a formal mapping that they were working with. So each one had a different style or even had multiple workbooks that they were doing with, which required extensive hyperlinking and click-through and functionality to them that wasn't easily reusable across teams. So you would get into this situation where we actually did the one-person team. That's something that's very common and that did happen. And he left the company, and the person that they brought in to replace him spent a very long time of his onboarding actually trying to understand his source-to-target mappings to go into the system and communicating that with the business side, because we're working with IT in this situation. So what the goal was as we go through, this is one of those jokes that I can't tell if it's going over well because I can't see the audience, but we're doing this kind of one all-inclusive file to keep track of. So creating that standardized mapping document and going through, because they were very intent at the time on keeping it in Excel. They said, no, we want to keep it in Excel. This is the easiest way to communicate this and to track this information, because nothing can do it like we need it to do, so we're just going to use Excel. So we have the situation where these teams have to constantly be communicating each other, and we're making sure that they're using this. And they have to be in a situation where they're updating that specific one. They know they're keeping it up to date, because all of these files are supposed to be in the same workbook. That's how they were delegating this. So then it was an attempt to de-silo the team. So we're going to all put our standardized mapping documents in the same one, and we're going to work through with that. Well, as I'm sure that you guys can process, that this exploded rather quickly because people weren't syncing, or people were saving and say, I'll upload it later, or they didn't like something specific on the mapping document, so they would slowly add columns onto it, or they would slowly take away columns from it. So this standardized one that was meant to be, we're using this no matter what, it's locked in, it didn't take a long time for that to slowly disintegrate and go back to how they were, because there was no way to actually keep that integrity intact, the cardinality intact, and making sure that these teams are working together. So that's where we're kind of trying to build out our story for this before I pass it off to Lee to show, okay, from a data modeling perspective, how can we come in and learn from our mistakes with what happened in this situation.
I'm Lee Hong. I am a senior data scientist here at ICC. Before coming to ICC, I was a neuroscience professor and researcher for about 8 years, and I used to live and breathe complex networks and complex systems theory before joining ICC as a data scientist. So the irony of this piece now is that I'm actually going to be presenting the least technical aspect of the entire webinar. And so where we are now is, how do we do this with Neo4j? We got a very, very complex data set. Right? We've got things that are mapped with many-to-many relationships. I've got columns that track the multiple tables. How do we break down all of that chaos into something that's very straightforward? And so this is what I love about Neo4j. We can whiteboard the data. So we start with the simplest components of our network. Right? We've got our source table, source columns, and source tables and source schemas. And then we've got a target on the other side. We got a schema that has tables that belong to it. Very simple. Next layer, we start adding tables in, and we attach our tables and columns to our schema. Next piece, we then connect our source to target at the column level. So this is very important at this point, because this is the key jump-off point, because we are going to have columns that connect to other databases, but our primary source of connection is going to be at the column level. And then the last piece of tracking that we need to worry about is the data type. So what we want to be able to know is if I've got one column that's right now in one form, when it gets transformed into its target state, what do I have left? So that becomes very, very important in data tracking, particularly in the financial services, because decimal points become very, very important. Some things are integers, some things are decimals, some things are numeric. So we'll see that importance as we start going through the insights that you can get when you start implementing this form of storing your data. So what the Neo4j database gives you is a way to escape from the pseudo-rigid hierarchy that Kelsey was talking about earlier. You have something that's supposed to be a tree, you started a leaf, you get down to the roots, you actually end up back at a new leaf, and you don't know which part of the tree you're on anymore. So that becomes actually really, really problematic. We're trying to manage all of these kinds of source to target relationships. So let's take some examples that we get from the data set that we have. Okay, so we're looking here, we've got a one source to target relationship, right? The blue node pointing to the gray node, which is our target. Interestingly, this source column actually belongs to two different tables that then belong to one single schema. So which one is our actual source that's being mapped to the target column that we see on the right? So if we were in the Neo4j browser, unfortunately we're not, but if I double click on this one node, this is what we see. So this one table holds tons of source columns, right? Plenty of source columns. But none of those source columns actually map to a target. And you end up seeing that both of the tables contain all of the same columns. So just by this simple exercise, we have been able to identify that none of the data in that one particular source table actually have a target. That one table is completely redundant. It's just taking up storage space and is actually of no use to any business functions that you have. The next type of issue that you can start to see is the problem of tracking data type changes. And sometimes you think about an interest rate might have 3, 4, 5 decimal places, while you're capturing dollars and cents, that gets truncated at 2. And so that's a fairly normal practice. And if you're looking at this situation here, we've got a source column in blue and your target column in gray. The target column is a decimal. The source column is a numeric. In a SQL database, these are fine. They're functionally equivalent. There's no difference in them. The most important thing becomes tracking the scale and precision. How many numbers am I allowed to carry? How many decimal points? In this case, if I had something that looked like this, 99.999, and I map that to my target, I will get an error. So being able to track all of these things becomes very, very important. And then the last sort of benefit of doing this Neo4j exercise and transforming the data into a graph is you can start to address the many-to-many relationship problem. So this is one slice or subgraph that we have. I have 2 source columns in blue and 6 gray target columns. I have 1 source column that becomes 5 target columns. And then I've got 2 source columns that end up becoming just 1 target column. Now, if I drill down, I've got 2 source columns with 2 different source tables. Dig a little deeper, we find that one table is completely redundant. None of the data from that table actually make it to target. And as we expand our view, it gets even more complicated because now I've got this target table that I have mapped to. And if you see that target table now has target columns that now map to a source column that then attaches to another source table. And then this one source column starts mapping to multiple target tables. So this kind of complex network, in terms of the data lineage problem that we started with in BCBS 239, being able to know where my data came from when I provide a final number in a report to the regulatory compliance boards, I need to be able to know where my data started from and where it is going to end up. So this is critical in terms of being able to map everything in one single view. We are able to capture all of these complicated relationships without any hassle, any stress. And then there are other additional applications that you can get out of this. So with using Neo4j, you have the capacity to do path queries. So I can see in this fairly complex network that I have, going from business area, business initiatives, to subject area, to canonical attributes, to columns, to tables, to databases, how many things are actually affected if one database goes down? So here we've got the database right in the middle. This database actually touches many, many different business initiatives and affects 3 different tables and many columns and attributes. What this allows you to do is very, very quickly determine all the technological dependencies that you have. So if you think about a situation, that's fairly commonplace these days, is let's say there was a hack and there's a data breach in one database. How many tables are affected? How many clients' data would be breached? So being able to map this quickly and easily becomes critical. Another application that you have is you can then internalize and map the fault tolerance capacity of the databases that you have. So this is one method of doing it. We can look at the relationship between the number of connections that a node has on the bottom with the likelihood of me finding a node with that many relationships. So you see this is a particularly robust network because I've got lots of nodes with very, very few relationships, and I've got very, very few nodes with lots of relationships. Now what this type of network has is for every, let's say for every big node, my biggest node has twice the number of connections that the next smaller nodes have. So I've got 2 more, and then it keeps getting smaller and smaller. And as each node gets smaller, it has fewer and fewer connections. Now this becomes critical because if we're looking at a network, again, similar problem with there's a data breach, or if one database goes offline, how many things are affected along the way? And so having a network where I can just manage the big things, I can just worry about the big things and let the small things take care of themselves. And with that, I'm going to hand off back to Kelsey to discuss the pain points and how Neo4j resolves all these pain points with a good data lineage map.
So is that your non-technical piece?
Sorry, there's a little bit of technical stuff towards it.
So discussing our ROI, I actually had the privilege of going to a conference, an MDM and data governance conference last week, and one of the biggest things that we heard were the audience members wanting to hear feedback. Okay, well, what's my ROI? How do I get ROI? Because how do I get that buy-in that people need to understand that this is important because they want to have their return, right? So from our regulations perspective and our NEO perspective, so we have, it goes just beyond our risk mitigation as we have on here. So we have reduced time and personnel costs, singular 360 view of metadata and connected components, and easy end-to-end exploration of the entire enterprise data universe. And we're going to dive into each of these more specifically. From an improved efficiency, reduced personnel costs, we're not talking about downsizing by any means. So I want to make that perfectly clear. So we have on this graphic image, we're going from 4 to 2 people, meaning that those other 2 people can go do the work that they need to be doing every day. So how many times have we experienced where people aren't possibly able to do their day-to-day job, or people need them to do other work, and all of a sudden they're having the job of 2 or 3 people, and they're working 70, 80 hours a week because they're trying to track all of this information. And so by being able to actually leverage data lineage in a way that's appropriate to do that, you can really reduce personnel costs in the sense that people can start functioning in different areas where they're needed. Additionally, efficient data storage and processing, so that removing of redundant data sources that Lee was speaking to, and we walked through a couple of examples. If we're able to clean out that information that might be excessive, the redundancy, think about the savings that happen just by storage and processing, and also there is a cost savings to that as well if you're not actually keeping up all this unnecessary information and going through this extra processing. And you can also optimize your enterprise architecture. And if we're going through innovation of it. So how can all of these things be connected to each other? So when we're developing our 360 view of the customer, which is something that gets thrown out constantly now, how can I gain my customer insight? How can I prove that? That business concept and that business knowledge of really ties in your return, because if you have a business goal or even an IT goal, what do I want to get out of it? And if you view it from that way and discuss your ROI with that in that sense in mind, so how can it get me there? How can this information get me here? If you look at here now, if we're trying to develop that 360 view, all parts of that business need to be involved, and how can we link them all together, and how can be our most efficient way to get there?
Yeah, so thanks, Kelsey. So I think what you saw was Jonathan sort of describing how financial services regulation, especially BCBS 239, is really essentially a data governance and metadata management problem. And Kelsey went through and sort of illustrated how this is not possible to really solve with traditional technologies like a relational database. And I think Lee talked about how graph can solve that problem from a connected network perspective. All of this risk data, all of this financial data that you need from a regulatory compliance perspective can be mapped together and related together with the right context as a graph. And it's pretty straightforward to do that with Neo4j. And then I'll talk a little bit about why do we call it adaptive and agile? So if you look at Neo4j, it's a schema optional database. So what that means is you can start with a schema. So you have maybe 2 or 3 different silos that you're bringing together initially. And so you start with that, and as you add additional pieces of data, you can just add on to your existing graph. Or if you have 2 subgraphs, you can bring it together into one larger graph at any time. And that's really the agile approach to building this data repository as a graph over time, and support sort of the agile processes of development. And also this notion of microservices. So we've sort of called this our agile core architecture. And what that really means is if you look at different products out there that a financial services company has, loans, mortgages, deposits, cards, payments, and so forth. And as they come out with new products, they are then sort of combining these products to build innovative services. And you have some of the standard services out there like online banking, fraud prevention. So these services could be external facing or internal facing to the organization, like risk management is both internal and external, and so is regulatory compliance. But you will be creating new services as you go. And so a creation of a new service is really plugging existing services in new and interesting ways to build a new service. And so that is the agility that is needed by a financial services institution, not only for risk management or regulatory compliance, but any new services that they build going forward. And graph is really the right technology to put this together, because you can create a new market offer, a new service, by just leveraging the connections and the metadata associated with the graph to build this new services using microservices, which is the prevalent technology today, going at that part of the subgraph that makes sense for that microservice. So that's why we strongly believe that this is a new approach to not only regulatory compliance and risk management, but also new service development for financial institutions with this agile core architecture approach. Yeah, and there you go, Neo4j. So what is Neo4j? Neo4j is a native graph database. What that really means is that it is extremely performant because we store the the related nodes, the related pieces of data, the pointers to that along with the original piece of data. So you're able to sort of quickly traverse all the related items very, very quickly, in memory. So we are doing CPU arithmetic to kind of talk about it from a technology perspective, as opposed to doing index lookups and then going to find the next piece of data. We're just looking at the pointer and just doing some CPU math to go for the next pointer and so forth. Also, we're not like other NoSQL databases where they are sharding, and as a result, they're not ACID compliant. They talk about eventual consistency, which is really a fancy term to say, hey, we may be losing some data. In case of Neo4j, we don't lose data. We're ACID compliant even across a cluster, and we call that causal consistency. I talked a little bit about agility already from a developer productivity standpoint. Also, we have a lot of existing procedures, and the Cypher language is extremely productive language. It's sort of the SQL for graphs, and there's a lot of training material online on that. And lastly, we are very efficient from a CPU and memory perspective compared to some of the other technologies out there. So with that, I will conclude. This is sort of the last slide I was talking to you about. So just essentially determining the applicability of the regulation, reviewing it, assessing what you have in terms of data, where you have it, how to bring it together, and then implementing a data governance platform, with the data lineage capability, with the capability of doing the impact analysis, as Lee talked about. Then having the CRO really have access to all of this information, building the right KPIs to track all the key risk items from your organization perspective, and then complying with this regulation and having the right reports provided to the board and external people, regulators, etc. So with that, what I'd like to say is thanks, and also offer you some time to spend with Lee and me. If you want to discuss your particular situation, particular project with us, we're happy to talk about how graphs can solve your problem, how to build your data model, etc. And also, we'd like to offer a brown bag for your team if you'd like to bring us in and talk to you about how graphs can solve your metadata and data governance problems specifically related to regulatory compliance. So thank you again for attending.